Hello and welcome. You're watching Financial Planner, and today we're going to be talking to Feroz whether or not investing in closed-ended funds is recommended. Feroz, firstly, most people, usually I think investors or analysts demotivate investors from investing into a closed-ended fund. Let's begin by telling our viewers, should one even consider investing in a closed-ended fund first up?
Largely the answer is no. Closed-ended funds are a no-no, but there could be some closed-ended funds which have a very different philosophy, different ideation, different theme, and if there is no Me Too product on the open-ended side, you can still consider. So out of 100 closed-ended funds, in my opinion, 2-3 of them is what will have some relevance in your portfolio. So 97 would actually be ignorable. So you have to be very careful, and there has to be a very strong reason to have them, if at all.
Right, so if you have a case going of why one should be investing in a closed-ended fund, and assuming that we achieved or accomplished the fact that maybe a given closed-ended fund may be a good option, what does one need to keep in mind? I mean, past records, comparisons, are those the kind of things you want to keep in mind before you go in and invest in these?
I can't harp upon closed-ended funds being a distraction enough. That's why I've been repeatedly doing these kind of advices to the viewers. See, closed-ended funds earlier had a very heavy commission. So they were being pushed by advisors. Fortunately, there has been now parity between open-ended and closed-ended funds on upfront commissions. So that has brought down the focus on closed-ended funds by advisors. That was the biggest risk. Thankfully, we have a regulator who brought some sanity in terms of parity on the commissions. Point two, what should you keep in mind? See, if you're investing in a fund, it's important to understand the track record. So track record becomes the first important element, which unfortunately closed-ended funds don't have. And then most of these rating agencies don't rate a closed-ended fund because there's no data to substantiate a rating. So point one, there's no past record. There is no data available for the rating agencies to rate them as 1-star, 5-star, whatever. Third is that, but fortunately, the same fund manager would be managing some open-ended schemes. If at all you end up choosing one, you'll have to analyze the past performance of that fund manager, if not the fund. So that's the third point I'm making on the past performance thing which you highlighted. So analyze the past performance of the fund manager. If the fund has not existed, I'm sure the fund manager would have spent 10 years in the industry and he would have thrown up enough data.
You know, Feroz, these are usually much smaller size portfolios as compared to an open-ended fund, which would make me imagine that the expense ratio potentially could be higher. But the regulator again has put a cap on what these expense ratios can be. Does that sort of change? Is that different?
Yes, it is different for the same point which you made. Regulator has put caps depending on the size of the fund. So it can go as high as 2.5, and it can, for large funds, it can come down to as little as 1.75. By design, closed-ended funds relatively are going to be smaller in size because you get only 15-20 days to market them. So they are smaller in size. In effect, it implies that they would be in the highest slab of expense permitted. So closed-ended funds have of the same fund manager, at least have a 50-75% paisa difference, that is 0.5 to 0.75% more expense. Virtue of this is because of its size, and size is going to be relatively smaller in closed-ended funds.
I'm assuming, but as the name suggests, liquidity is tough on this one.
Correct. Closed-ended funds, you cannot send a redemption to your fund house. You have to find another customer on the exchange to be able to sell it. So liquidity is low. There is another source of liquidity, which is a third-party customer who can buy your units from you on an exchange platform. So liquidity, one is it is a different path. Second is there is low liquidity.
Also, there is only a lump sum option here, right? Because if it's closed-ended, you can't obviously do an SIP.
Correct. So systematic investment plan, which becomes the key driver for a retail investor or for any investor who is actually getting recurring incomes, you don't have a recurring investment. So if you start with a small amount, and even if the fund does well, you can't scale up your amount. So SIPs are not permitted, nor is there a further lump sum investment permitted.
So that's all you need to keep in mind when you consider investing in a closed-ended fund. It's not highly recommended, but if there is no Me Too product, and if you're sort of impressed by the ideology, strategy, and of course goals of that fund, it may be worth looking at. But Feroz has highlighted a few factors you want to keep in mind before you do that. With that, completely out of time. Thanks for watching.